The IRS just released their new tax brackets for 2025, and millions of taxpayers are now going to pay less taxes on their next return. Specifically, these new brackets will allow you to report more of your income at lower tax rates. You are also going to have a higher standard deduction, which also means less income reported on your tax return. For investors, you will be able to report more of your capital gains at lower tax rates too. And for my people who love to save money, these changes will allow you to put more money towards your HSA, retirement accounts, and other tax deferred accounts. So as someone who has already read through all of the revenue procedures pertaining to these changes, and as a licensed CPA that tax plans every day at mycpacoach.com, I want to provide you with a very simple and easy understanding of how all of these changes may affect you. So let's go ahead and jump in. Okay, so let's start with the new individual tax brackets for 2025, and then we will walk through other key changes that you need to know. So first of all, many people misunderstand individual tax brackets. For instance, they think that if they are in a 22% tax bracket, that all of their income is all of a sudden taxed at 22%. But that is not how our tax system works. So let's walk through this. So first of all, the 2025 tax rates will range from 10 to 37%, but I want you to think of this like a bucket. And the first portion of your income that goes into this bucket will be taxed at the lowest tax rate. So for example, for single taxpayers in 2025, the first roughly $12,000 of your income will be taxed at 10%. Then income above this range will be taxed at 12% up to about $48,000. Then income above that range will be taxed at 22% up to about $103,000. So someone who is earning $100,000 per year as a single taxpayer would pay different tax rates on different portions of their income. And from there, your tax as an individual will continue to rise to 24%, 32%, 35%, and eventually up to 37% based on your income. But what I want you to pay attention to are the big jumps in tax brackets. So when we look at this, the first big jump is from 12 to 22%, which is a 10% increase in your marginal tax rate, which means you'll pay an extra $1,000 on every $10,000 in income you report on your tax return. And the next big jump, which is usually when clients start calling me to help them, is when your tax rate goes from 24 to 32%. Which happens when you're earning over $197,000 as a single taxpayer in 2025, representing an 8% increase in your marginal tax rate that year, which means you will be paying an additional $800 on every $10,000 in income reported above this range. Or in other words, with a 32% tax rate, your total tax on $10,000 in income in that threshold is $3,200. And from here, tax rates continue to rise based on your income. So you'll pay a 35% tax on income above $250,000 and a 37% tax on income above $530,000. Now, believe it or not, these tax rates are actually much better than what we saw in 2024, which we'll talk about in a moment here. But first, let's talk about the new tax rates for married taxpayers as well. Now, if you don't know, as a married taxpayer, you are basically able to get twice as much income into most of these same tax brackets, which surprises many of my clients. And funny enough, I have even had clients who have decided to get married after realizing this. So whether you're married now or not, this still may be important to you. So let's walk through this. In 2025, married taxpayers will pay only 10% tax on up to almost $24,000 in their income, twice as much as the $12,000 limit we saw for single taxpayers. And then they will pay just 12% tax on up to about $97,000 of their income. Now, just think about it. To earn almost six figures in household income and pay a maximum tax rate of just 12% is a pretty good deal and will be big for millions of taxpayers. And we haven't even talked about the new standard deduction yet, which we'll get to. But once you get above about $97,000 in income, your marginal tax rate will take another big jump up to 22%. And this is when taxes start to become a nuisance for these taxpayers. And once you're earning over $207,000 in income, it jumps to 24%. And then there's another big jump to 32% once you're earning over $395,000 as a married taxpayer, which is usually when taxes start to become a very big problem for these taxpayers. Then it goes to 35% once they are earning more than $500,000 and up to 37% once they are earning over $750,000 per year. Now, with all of that said, you're probably wondering, how exactly is this different from the 2024 tax brackets, and what about the other deductions? So let's talk about it. I ran the numbers on this, and you can fit almost 3% more of your income into each tax bracket thanks to the new inflation adjustments made by the IRS. For example, in 2024, the maximum income limit for the 22% bracket was just $192,000 for single taxpayers, but in 2025, it's $197,000. So that's a $5,000 difference in income with a 10% difference in tax, meaning that someone with the same amount of income would save about $500 more in taxes in 2025 as opposed to 2024. Now, keep in mind that this is just a very small example, but these small increases in income across every single tax bracket could easily save someone a few extra $1,000 in taxes once accounted for, which is going to be a good thing for most taxpayers. Plus, once we account for the increases in other deduction limits, like the standard deduction, for example, taxpayers would save even more money in taxes. So let's switch gears here for a little bit and talk about the other tax changes other than these tax brackets that will ultimately affect your bottom line, starting with the standard deduction, since 90% of taxpayers take this deduction. So in 2024, the standard deduction was $14,600 for single taxpayers, about $22,000 for head of household filers, and $29,200 for married taxpayers. But in 2025, the standard deduction will be increased to $15,000 for single taxpayers, $22,500 for head of household filers, and $30,000 for married taxpayers, still representing about a 3% increase from 2024. And if you want to get an idea of how much more money this saves you in taxes, just take your max marginal tax rate and multiply it by this deduction. So for example, someone who is married and is in the 37% bracket would save over $11,000 in tax from this deduction alone, or an extra $300 in taxes when compared to 2024's standard deduction. Now, for people who take the itemized deduction, this would also mean that your itemized deductions would have to be even higher now for it to be more beneficial than the standard deduction. And usually people only take the itemized deduction when it exceeds the standard deduction. So this deduction being higher makes the itemized deduction less useful for taxpayers who use it. So you will want to carefully weigh these options with your CPA. But outside of the standard deduction, there is still one big change we need to address, which will affect almost every taxpayer with assets or investment sales, which are the new capital gain tax rates. So if you don't know what a capital gain is, it occurs when you sell an asset or an investment for more than what you paid for it. So if you paid $5 for a stock, for example, and you sold it for $11, you would have a $6 capital gain. Now, capital gains that you have held for less than 12 months would be taxed as ordinary income, or basically according to the tax brackets that we just went over. But when you have a capital gain on an asset that you've held for greater than 12 months, then it would qualify as a long-term capital gain, and those have lower tax rates, which is also where we have new changes for 2025. So in 2025, long-term capital gains are taxed at 0% for incomes up to about $48,000 for single taxpayers and $97,000 for married filers. And then above that range is taxed at 15% up to about $530,000 for single taxpayers and $600,000 for married taxpayers. And then above that, all long-term capital gains are taxed at 20%. Now, these income thresholds represent about a 3% increase from what we saw in 2024, which would again save taxpayers more money in taxes if they have about the same amount of income. For example, in 2024, a married taxpayer with $97,000 in income would pay a 15% tax on their capital gains above $94,000, equating to a $450 capital gains tax on a $3,000 capital gain. In 2025, however, they would pay a 0% tax on this gain, saving them that $450 because the new maximum limit is $97,000, qualifying them for a 0% tax rate. Understanding these tax brackets is key to saving more money in taxes because you can now make decisions on when and how you want to report your income. For example, individuals may want to trigger capital gains tax when they are in the lowest possible tax bracket, instead of doing it in a year where they are reporting a lot of income and are in a high tax brackets. And individuals with earned income may do the same thing. For example, someone being taxed at 32% may seek to make more tax deductible investments to lower their taxable income to the 24% tax bracket, 22%, or even lower. Plus, on top of all of this, there are even more tax deductions that will increase in 2025 as well, such as contributions to your health savings accounts, retirement accounts, and so on. Now, at the time of this video, there are several sources that are speculating the amount of the increases for these sorts of accounts. But as of right now, I do not see anything from the IRS that is official regarding those increases, so make sure you subscribe to learn more about those when it comes out. But all of this will help you take control over your taxes, which is why tax planning is very important. And if you have a very high tax bracket right now and you want a plan that is guaranteed to reduce it, just go over to mycpacoach.com today to apply to work with one of my CPAs. Thank you for watching.